We're now going to bring in Erik Hirsch. He's the Hamilton Lane co-CEO. And Erik, you look at this new kind of deadline of August 1st. August is a month that most people like to go away on Wall Street. This seems to be a summer that is going to have a lot of prolonged uncertainty. And I'm wondering how your clients, how investors, how other firms that you work with in the fund management industry are dealing with that prolonged uncertainty.
Shanali, great to be back. Good to see you. I think we're in for a choppy summer. I think no one's going to get the free break that they were hoping for in August. There's going to be a lot of negotiations. There's going to be, I think, a lot of deals struck. And we continue to see this administration use these tariffs as tactics and as tools. And that does not appear to be changing.
What do you think about, the impact of tariffs? We expected it to be pretty horrendous at the beginning of April. And now it seems like something that our trading partners and U.S. consumers can live with. Are you reading it the same way?
I am, Matt. I think the administration is telling us two things. They want to get trade rebalanced in a way that they perceive to be more fair and equitable. And at the same time, they are very conscious of not harming the markets. They're clearly keeping an eye on what's happening in the markets, and they're adjusting posture as needed to make sure that the markets remain strong.
When we think across markets, outside of even traditional way equity markets, the bond market in particular has been so interesting. Just a day ago, Matt and I were sitting here saying at 4.3% on the 10-year, there's really nothing to cry about. But then we drift today back to 4.4%. We are off the highs of this year, Erik. But at 4.4%, you don't see the Treasury Secretary calling victory here in the bond market. How is that 4.4% feeding through across private credit, fixed income managers, people who really find difficulty navigating through elevated interest rates?
So this is an interesting thing. I think you're seeing a bit of a disconnect right now between the equity markets and the bond markets. So I think that sort of continues to bear watching. Now, the rising rate environment is still not causing a slowdown on private credit. In fact, in some levels, it's continuing to accelerate because what you're seeing is not so much a huge move by institutions into private credit. They've already been there, but it's really the individual investor that's beginning to pivot more aggressively, taking advantage of what the private markets are offering. They have not had exposure to that to date, and they're beginning to make that big change significantly right now.
Erik, I have a trader friend that I talk to all the time. We do the back and forth on Trump did this and Trump did that. And he's always saying, look, deregulation is going to be an opportunity. This is going to benefit the U.S. economy, a tailwind. And I'm trying to suss out what the actual deregulation opportunities are going to be. What's your take on that?
I think historically you've seen deregulation benefit larger corporations as they just continue to expand more rapidly. I think the thing that we're looking at more closely is the amount of capital that's going to be plowed back into the U.S. economy as we're continuing to make a huge effort here to reshore. So to me, the tariffs are really about two things. It's about sort of that equitable redistribution that we talked about earlier. But more important, the administration is telling us very clearly they want to put manufacturing of certain goods and services back in this country. And that's going to take real infrastructure spend to do that. So there's a job creation element, but there's also power needs, hardcore infrastructure, building, et cetera. So all of that, to me, is also big capital flows back into the country that we also need to keep an eye on.
Can I ask about then specifically private markets, because you have a specialization there, and we've seen incredible growth, right? Shanali's been covering this like crazy. Is that going to continue? Does that have legs? Does a lot of this capital flow into private markets and not necessarily all into publics?
I think the private market is really becoming a little bit more bifurcated right now. So institutional flows into private markets are actually slowing. So the institutional investor generally at exposure, waiting for more liquidity to come out of the system. And so we're not seeing record institutional fundraising. Where we are seeing record flows is more back to that retail investor. So as the industry is opening up to that individual investor, their flows are significant. But I think it's important to recognize that those flows are being captured by a very, very small number of managers. There's really just a tiny subset of very large firms, including firms like Hamilton Lane and others, that are really benefiting from that. But that's not enjoyed sort of success by the entirety of the industry. And so those flows are being captured by a very small number of players, but those flows are significant, in some cases offsetting where you're seeing the weakening from the institutional side. And I don't expect to see that slowing. That is continuing to accelerate.
Erik, with more retail investors looking to private markets for an opportunity, my major question is, what does the ugly look like right now? Because there is a lot of bifurcation, as you say. There's a lot of dispersion in returns, and there are corners of the market that are clearly showing cracks. So what's the advice there for people to avoid the damage?
I don't think this is new, Shonali. I think you've covered this for a long time. Our industry, despite maturing and growing and doing all the things that it's been doing, has continued to have a very, very wide gap of performance. So the pundits have been telling us for years that as our industry grows and matures, et cetera, that compression of returns will happen and will happen significantly. That has been wrong. The compression has not happened. The dispersion continues to be very wide. Great managers are still generating great performance, and bad managers are still generating really bad performance. That's not changing. It's why sort of buyer beware is very much sort of the mode of the day here, of making sure that you are choosing and selecting carefully, because if you're right, you're right, and if you're wrong, you're very wrong. And that's why firms like ours continue to exist, because there's a skill set and a history of doing that successfully.
Erik, we love to get your intel. Thank you so much for sharing your time with us. Erik Hirsch there of Hamilton Lane.